Hey guys, I'm Phil Town from Rule 1 Investing, and today I want to talk to you about risk versus reward in investing, and more importantly, if taking more risk when you invest actually gives you more rewards, or is it the other way around? As a reminder, make sure you click the subscribe button and the bell icon to get notifications when I release new videos. Risk and reward are the yin and yang of investing. Both are always there, though it's certainly possible to reduce your risk and increase your reward if you follow the ruler investing strategy, in my opinion. Now, before we go about reducing risk and increasing reward, though, I think we first must understand what the risk and rewards are and what you can do to alter them. At face value, the risk in investing is the possibility that you will lose your money. Now, this is an unfortunate risk, seen as the entire point of investing is to grow your money rather than to lose it. However, there are a few factors that will increase this risk very substantially if you fall prey to them. The first of these factors is buying a company that you don't understand. That'll do it. Investing in a company requires that you believe in that company's potential to grow its value over time. However, your belief in a company has to be grounded in knowledge about the company, its management, its future outlook, right? Its moat, and more for that belief to have any justification at all. If you invest in a company at random, just because, I really like Facebook, without understanding it, you are not investing. You are just gambling. And gambling comes with a lot more risk to it than investing does. The second factor that can increase your risk is buying a company without a proven track record of growth. It's true that past performance is not a perfect indicator of future performance, but a company that has been consistently growing in value over the years, it's a lot more likely to continue growing than a company that's been in a slump is to turn things around and start growing again. Finally, the third factor that can increase your investing risk is buying a company that's led by an untrustworthy management team. Even the most promising companies can and have crumble due to dishonest management, self-involved management. Now, this may be management that is dishonest in the sense that they intentionally hide risk from their investors, and dishonest in the sense that they are more interested in padding their own pocketbook than in growing the company, or dishonest in the sense that they cut corners and cross the line of what's legal and ethical to make their numbers look better. In all three cases, though, investors in that company often end up paying the price, and we want to avoid that. So these three factors contribute to risk in investing more than any others, and avoiding them can greatly reduce the risk you face. But what about reward in investing? What factors can help increase your reward? Well, before we discuss how you can increase your potential for investing reward, we first got to understand efficient market theory, and to understand that it simply isn't true. Efficient market theory states that the market is effective in pricing companies and pricing them at a level that reflects their true value. In other words, according to efficient market theory, companies in the market are never overpriced and never on sale. They're always priced properly. If this is true, then the best thing to do would be put all your money in an index and just hope the overall market continues to grow, because trying to buy an individual company becomes a 50-50 bet at any moment that you buy it, that it goes up or down. In other words, it's just a crapshoot, if efficient market theory is right. However, if efficient market theory isn't an accurate description of reality, then the reality might be that the market does overprice and underprice companies all the time due to a wide range of factors, sometimes by a major degree. Now, this creates a new risk in investing in a company that's overpriced at the time you purchase it. However, it also creates the potential for significant reward. Reward in investing comes from finding quality companies that are priced by the market at a point that is well below their real value, their long-term value. The efficient market theory may not be true in the sense that companies are always priced at their right value, but it is true in the sense that the price of companies almost always eventually rise or fall to reflect the true value of the company at some point in time. Ben Graham used to say that the stock market in the short run is a voting machine, but in the long run, it's a weighing machine. Now, what this means is that if you purchase a company that's underpriced by the market, something below its real value, you can just about count on your investment growing in value over time. Now, the key to finding those quality companies that have been underpriced by the market is to find companies which you understand, which you know the value of, which you know management team is good, and which have a durable competitive advantage. And this is what Rule 1 teaches you to do. This is what our whole company is all about. This is what all these videos are about. And if you can find these companies though, your rewards will almost always outweigh your risks. Now this is really cool how this works with Rule 1 investing. We think actually that we take less risk by buying a handful of great companies we understand when they're on sale than you do by simply buying the index. Now, I'd love to hear from you guys. Do you think that the stock market is risky? And is that what's keeping you from investing? So leave a comment below with your answer and I'll be sure to follow up with you. And thanks for watching, you guys. Now go play. If you enjoyed this video and you feel it was valuable in teaching you more about risk and reward in investing, hit the like button and please share this video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen for a free gift. And thanks for watching.